Stocks down, gold up, so listen up, because my next guest has been right on back in 2008 saying gold would hit $1,500 and beyond. It was around $800 then. Today it's pushing $1,800 plus. Now Aaron Smith is saying we haven't seen the end of the carnage on Wall Street. In fact, we may have just begun. Aaron is the CEO of Superfund Asset Management, uncannily prescient, and that's what worries me. Aaron, what do you see now?
Oh, good evening, Neil. Last time I spoke to you in April 15th, gold's been up over 300 points since then. I suspect that that trend is intact, and we will continue to see gold and silver increase, probably not just in U.S. dollars, but especially in euro, as well as Japanese yen.
Why?
So
What's
that is
driving
something
it,
that
Aaron? Because on the surface it looks like a bubble to me, but I guess it's not, at least not yet. What's driving it?
Most Americans just don't own gold, and if they do, they own maybe 1 or 2 or 3% of their portfolio. We're nowhere near bubble proportions. But what's driving it is the fact that there is a major risk that at the fringe, major corporations, major sovereign governments, municipalities will all default in the next 2 to 3 years, and that's in a very close to zero interest rate environment. So with the default risk just in Europe, if America was perfect, AAA, everything was fine, gold would still go up just based on the issues that we see in Europe today. And the strong buying that we see in China.
By the way, Fitch Investors says we are just fine. They maintain their AAA rating for whatever nefarious reasons. I'll leave that out. But you're not buying it. You think there's a slippery slope here. It's going to hurt our stocks, other stocks, and be good for tangible items like gold?
Well, actually, in reality, the U.S. ought to be AAA. The reality is there is no real threat of a default because we can actually increase the money supply at will because the U.S. dollar is today the world's reserve currency.
I grant you, but that's hardly a pat on your back, right?
Well, yes. The reality is that with a zero interest rate environment, we're going to see stocks continue to go up because if you have
how much? So what you mean? So we're not necessarily going to go into some bear market here, or what are you saying?
I don't believe so because if you have $1 million sitting, you know, you're making less than 20 basis points in a money market, so that money has to flow somewhere.
And gold goes up for the foreseeable future. How long will that be?
Exactly, and that will happen until interest rates start to rise. And that right now, the Fed has got interest rates at artificially low levels for the longest time that it's ever done in the past 60 years.
2 years more.
So it's not a prediction, it's just common sense, because if you take a look at it, you know, last time rates were this low, we had the subprime crisis. Before that, we had the tech bubble. Well, what bubbles are we creating now by having a zero interest rate environment? And I believe that as we start to see corporations, governments, municipalities default, it might take 2 or 3 years, but you'll see interest rates start to go up at the short end of the curve, 200-300 basis points. That's when stocks will really crash. If interest rates are at 4%, the 100-year average, today, Dow Jones would be trading at 2008 valuations, period. The only reason the market's where it is today is because interest rates are low and stimulus.
Wow. All right, Aaron, love to have you back. Thank you. Good stuff all. Aaron Smith in Detroit.
While your family is together for the holidays, schedule your family portrait at Visions Unlimited Photography.